Welcome and thanks for joining this talk on capital outflows and future shock. This opening slide sets the scene. Capital moving through complex channels, shown by the arrows and blocks, and the central question we'll explore is why money is leaving certain markets faster than it arrives, and what that means for policymakers, investors, and emerging economies in the years ahead. This page gives a 2026 snapshot of global capital dynamics, summarizing three trends: large outflows from China and fragile emerging markets, a velocity problem where departures now occur roughly 4 times faster than arrivals, and increasingly selective inflows that favor nearshore Asia, renewables in Latin America, and African data hubs, which shrinks the set of quality destinations for new capital. Here we move from old drivers like interest rate differentials to modern overrides such as sanctions, reshoring, and block-based trade rules that create policy uncertainty. Investors now discount that uncertainty up front, producing sudden portfolio reversals, undermining central bank easing, and turning formerly long-term assets into near-term liabilities through local currency pressures and higher debt burdens. This slide highlights the great divergence. Venture capital concentrates in a handful of US AI champions, producing valuation, bifurcation, and starving non-tech segments in emerging markets. At the same time, global funds accelerate offshore exits, reallocating capital toward firms with scalable data and compute, which amplifies concentration, raises exit risks, and drives the rebalancing pressures behind future shock scenarios. We illustrate a self-fulfilling vicious cycle. Capital outflows trigger financial stress and wider sovereign spreads, prompting central banks to tighten policy or hike into a slowdown, which then depresses growth and feeds further outflows. The upshot is a reinforcing loop where policy responses can unintentionally deepen the underlying capital flight and economic contraction. This graphic walks through reserve depletion and capital drain as a staged spiral. Countries burn reserves to stabilize their currency. Buffers evaporate quickly over a few quarters. Coverage falls below IMF adequacy thresholds. Seeking program support creates market stigma. Investor avoidance deepens. And the initial outflow problem accelerates into a broader capital drain that reinforces the crisis. The proposed 3-layer shield stacks defenses to reduce systemic vulnerability. Layer 1 establishes real-time dashboards for continuous capital flow monitoring and early warnings. Layer 2 creates contingent FX swap lines among regional blocks as liquidity backstops. And Layer 3 explores gold-backed tokenized reserves to enable swift sterilization while preserving monetary sovereignty and credibility across regimes. On strategic allocation, the recommendation is blended finance and long-duration solutions that pair core AI exposures with adaptation infrastructure and private credit in target emerging markets. That means investing in resilient energy grids, climate-smart agriculture, and SME financing alongside AI infrastructure, and using blended finance wrappers to convert exit risk into long-duration premia to stabilize balance of payments in recipient countries. Finally, capital flight is shifting from episodic emergencies to a chronic condition, so jurisdictions need durable responses. Embed transparency with open reporting, build regional liquidity buffers for crisis support, and create AI-resilient, real economy investment slots to keep savings at home. The goal is to turn outflows into reversible, mutually beneficial flows rather than persistent capital loss.